Fed reports massive spike in defaults. Credit cards being shut off. Hey everyone, welcome back to the channel. Today we have some critical news about the US economy that you need to hear. The Federal Reserve has reported a massive spike in credit card defaults, and it looks like the credit card bubble in America is on the verge of popping. So let's dive into what's going on and what it means for all of us. The credit card default rates are skyrocketing right now. People have stopped paying their credit card bills, leading to a surge in delinquency rates. A recent study by the Philadelphia Fed showed that the almost 3.5% of card balances were at least 30 days past due. This is the worst on record, signaling a huge level of consumers' stress in the economy. Remember, the 2007 and 2008 financial crisis, back then the charge-off rates on credit card loans was over 4%. Fast forward to the fourth quarter of 2023 and we are seeing 4.2% charge-off rates, the highest since the last major recession. While this doesn't guarantee we'll see a downturn like a 2008, it is definitely a red flag, a big red flag. Credit card debt hit a staggering 1.13 trillion earlier this year, the highest level of all time and 20% higher than before the pandemic. People are struggling to pay their bills, and with the average interest rates on credit card plans spiking to 22% in early 2024, the situation is getting worse. Many households got used to higher spending during the pandemic due to government stimulus check. Now, without these checks, people are relying on credit cards. This is unsustainable, and at some point the consumer is going to break. When that happens, we could see surging unemployment rates and a stock market crash. So looking at retail sales data, spending spiked in early 2022 but has since flattened. This indicates that while spending levels remain high, they are being supported by a record amount of credit card debt, a dangerous trend. One of the most shocking findings is from Discover Financial. Their charge-off rate in the first quarter of 2024 was 5.66%, nearly double from a year ago and the highest since 2008. This suggests that the situation is deteriorating rapidly. It's not just Discover. Other major issuers like Wells Fargo Bank of America and JP Morgan are also reporting higher charge-off rates. Interestingly, American Express is an outlier with charge-off rates similar to pre-pandemic levels, which states are likely to be hit harder by this recession. Forbes analysis shows that Florida, Mississippi, Arkansas, Louisiana, South Carolina and Georgia are struggling the most with credit card delinquencies. These areas might see the first sign of economic and housing market downturns. As people struggle to pay their credit card bills, they might also fall behind on rent and mortgage payments. This could lead to increased vacancies, forced selling from real estate investors, and a drop in housing prices, especially in states like Texas, Mississippi, Alabama, South Carolina and Florida. So what does all this mean, right? It means we need to pay close attention to these warning signs. This credit card debt bubbles is growing and growing, and when it pops, it could have serious repercussions for the economy. So stay informed, make wise financial decisions and keep an eye on these developing trends. Thanks for watching, and don't forget to like and subscribe for more updates. Thank you. Take care.